In this video, we will illustrate the power of compound interest. And we will do this by showing you the amount to invest per month to live a comfortable retirement. First, we need to come up with an amount that you can actually live on per month in retirement. Say $2,500 is needed to comfortably live on. If you multiply this by 12 months, you get $30,000 a year. This amount of course varies per person, but for the sake of this video, we will use $30,000 per year. But how much money do we actually need in total to live on $30,000 a year? It is tricky to just assume we will live a certain amount of years in retirement and just multiply that amount by 30,000. Well, if done wrong, that could lead to a nasty surprise, so we do not want to do that. And this is where the 4% rule comes into play. This rule implies extracting 4% of your total principal amount every year. And this 4% should in our case equal 30,000. And our principal amount should just be 30,000 divided by 4%, and that equals to $750,000. You can also calculate this by taking the 30,000 and multiplying that by 25. The beauty of the 4% rule is that you never run out of money, at least in theory. The US stock market has historically returned around 7% per year, and this is adjusted for inflation. The theory suggests that if you initially withdraw 4% of your money and add a yearly return of 7% to that, your initial amount will have grown to more than the amount you started with. You are even able to spend 4% of it. But this is of course only a theory, and it does not take things like market volatility into account. The market is highly emotional and cannot guarantee us a smooth ride in every year. But when looked upon in the long term, this theory does seem to work. You can of course be even more conservative and assume a percentage less than 4%. I will leave a link to a calculator in the description below so you can play around with the numbers yourselves. We're now going to calculate what you need to set aside per month to achieve this goal of $750,000 in retirement. We will assume a retirement age of 65 just for the sake of this video. The amount we put aside each month will of course be put into an investment account, so we can invest it. We'll assume a long-term compounding rate of 7% for that. The amount needed to put aside per month of course depends on how many years of investing you have left. The amount needed to invest per month will of course be smaller when you start early when compared to starting near retirement. You namely have more months to invest and more time to let your investments compound. This means reaching $750,000 is easier when you start early. We're now going to calculate exactly how much you need to put aside per month at a certain age. If you start really early with investing, say at age 20, you have 45 years to compound your money to the $750,000 needed at age 65. And according to the calculator I used, you need to put aside $219 a month to reach this goal in retirement. Say you wait another 5 years with investing, meaning you'll be 25, you already need $313 a month to achieve this goal. Well, that's an increase of almost 43%, and if you start at age 30, you need to set aside $452 a month. Starting age 35 means you need to set aside $661 a month, and almost $1,000 is needed a month when you start at age 40. Starting age 45 means you need more than $1,500, and $2,500 a month is needed at age 50. You need to set aside almost $5,000 a month at age 55, and if you only begin investing until you're age 60, well, that means you need to set aside more than $10,000 a month to be invested. And for most people that is pretty unreasonable to say the least. You can see that the amount rises exponentially as your time horizon shrinks. This illustrates the power of compound interest. The money you invest the earliest has of course the longest to compound and is thus the most powerful. Compound interest is even considered the eighth wonder of the world according to Einstein. The mistake a lot of people make is that they find out it's too late. It may seem discouraging to see such high amounts needed to be set aside when you're already a little older. This should however not discourage you from investing in the first place. It's better to start late than never. If you liked this video and enjoyed to watch similar content, consider giving a like and subscribing to the channel. Thank you guys for watching, and I'll hope to see you in the next video. Take care.